My name is Ed Edick. That's me. On behalf of the Board of Directors, I want to thank you for being here today. We had a record attendance at this event last year, and believe it or not, there's even more of you here today. You know why that is? I'm sure it's because we're serving wine after this event instead of coffee first thing in the morning. It was my idea. Last year was my idea. And I think by the time I'm done with my many years on the board, that's the one thing I'll be remembered for. Wine. But in addition to the refreshments, there is so much more that goes into this event and all of the other work the Economic Forecast Project does for the Santa Barbara community. This is a collaborative effort by the university staff and faculty, as well as the Santa Barbara business community. At this time, I'd like the members of the Board of Directors to please stand and be recognized. Stand up. If you're on the board, stand up. They're very modest. In addition to their busy personal lives, they dedicate countless hours to the Forecast Project, and I am proud and pleased to call them my friends. But in addition to all their great efforts, it takes many dollars to make this machine run. Without the continual support of our fine sponsors, we would just not be here today. If you're here at the invitation of one of the sponsors, would you please take a moment after the event to thank them for including you? While all of our sponsors are important to our efforts, I really need to take a moment to acknowledge several of them. Those are our gold sponsors, American Riviera Bank, Blackbird Investment Group, the Deckers brands, we all wear those shoes, UCLA Health, I think we've stacked the audience, okay. And then the UCSB Alumni Association and the UC Santa Barbara Foundation. Our platinum sponsor, once again, is Montecito Bank and Trust. And since the beginning, our founding sponsor, U.S. Bank Private Wealth Management. In addition to all of them, we get some really nice support from the Gretler Foundation. I never met Mr. Gretler, but I really wish I had. Anyways, we have a fine lineup of speakers today. I was fortunate to spend a couple hours with them yesterday, and I think you're in for a real treat. And based on the timing of this morning's announcements regarding trade, I think you're going to really enjoy it. But before we get started, I'd like to introduce someone who really needs no introduction, Dr. Henry Yang, the Chancellor of UCSB. Henry?
So, good afternoon, and welcome to our 2025 South County Economic Summit, hosted by the Economic Forecast Project of UC Santa Barbara. Since 1981, for 44 years, the project has provided our community with information on economic, demographic, and regional business trends. This yearly summit helps inform the vision and the decisions of our business leaders, our local educators, and our elected officials. I want to say a special thank you to our distinguished speakers. First, I would like to thank Professor of Economics, University of Rochester, George Alessandria. I also want to acknowledge the Dean of Mitch Daniels Schools of Business at Purdue, Jim Bullard. And I spent 25 years before I came to Santa Barbara at the Purdue University, 10 years as the Dean of Engineering, managed a National Science Foundation engineering research center called the Intelligent Manufacturing Systems. We work with the Cranor School of Business School at Purdue quite a bit, so glad to see you, Dean Bullard. Also, I would like to acknowledge Director of the Ettinger Family Program in Macroeconomic Research at the UCLA, Lee Ohanian. And also, of course, I would like to acknowledge our Professor of Economics and Director of Economic Forecast Project, Peter Rupert. This summit, in part, is a reflection of our campus reputation as a center for innovation and entrepreneurship, and our commitment to promote economic growth for our community, our state, and our nation. Forbes has listed the UC Santa Barbara among the top most entrepreneurial universities in the country. We average about 90 to 100 invention disclosures annually, nearly half are under licensing agreement. Another small example, Times Higher Education of London has given a very credible ranking of all the 726 universities in the world about interdisciplinary sciences, meaning including AI, engineering, computer sciences, and the physical and the biological sciences, and they're interdisciplinary with social science, economics, and also humanities. So UC Santa Barbara ranked number 8 in the world in this ranking. Yeah. Our university is fortunate to be part of the Santa Barbara dynamic community, such a sophisticated community. We are very proud to be part of it. Together with our community, we are advancing innovation and creating new companies and jobs. So I want to thank each and every one of you for your support, your vision, and your commitment. Thank you for attending this wonderful meeting today. Thank you.
Stay here a second. So many of you know the Chancellor is stepping down as Chancellor at UCSB. He's been wonderful to not just UCSB, but the Forecast Project. Before he came here, he's mentioned he was at Purdue. He was the Neil Armstrong Endowed Chair of Astrophysics and something else, something. He's not retiring. So Henry still sees students, he still has PhD students, and he's finally going to get back to doing something that's useful in the classroom. So please give it up, Chancellor Yang. Thanks, Henry. Hi, I'm Peter Rupert. I run this thing. It's a great program. Can't be more timely to have some talks about what's going on with international trade, what the Fed's thinking, policies in California. And the 3 speakers today, by the way, except for me, the 3 speakers today are fantastic. There aren't 3 better people in the world that I would want to be standing here talking about their respective issues. The first one, George Alessandria, and it's very interesting, by the way. So Jim Bullard's now at Purdue. I got my PhD at Rochester. Lee Ohanian got his undergrad degree at UCSB, and then got his PhD at Rochester, New York. And George Alessandria is now a professor at Rochester. So it's a Rochester and Purdue event today. So I'd like to introduce George Alessandria, who's going to talk about international trade. He runs the Rochester Center for the Global Economy. George.
Thanks, Peter. Appreciate it. Thanks for the kind introduction, and thanks to all of you for coming. I'm going to talk about the global economy and tariffs. Let me start with just the state of tariffs, and there's nothing on the screen because, so I made my slides this morning. They're up to date as of 10 a.m. Things have been moving relatively quickly. So let me try to I'm going to take us through many years of trade policy and bring up some issues related to what could be happening in the aggregate economy. It's just not a simple time, but it's a time we've been through many times in U.S. history. So where do we stand right now? Well, tariffs have risen from near historic lows. When I wrote these yesterday, Chinese tariffs were 145%. There were major exceptions. Our iPhones were not really getting tariffed by very much. And then we had a deal last night that took Chinese tariffs back down to 30%. Okay? On the flip side, the Chinese were tariffing American goods by 125%. That's now down to 10%. There's a bunch of other tariffs on steel, aluminum, autos. We had these Liberation Day tariffs, right? We saw the formula, tariffs from 10 to 100%. Those have mostly been put on pause, but there's a 10% tariff. And then we've seen large effects on markets, right? I don't know what happened today, right? Something happened. We can all retire a little earlier. Exchange rates, and then the economy. So that's where we sort of are for now. One thing I want to talk about, though, is this could all be part of a major renegotiation. So when we kind of look at trade policy, the president has basically been given power to negotiate trade policy for about 100 years. Usually it's a very clear process where Congress gives them a mandate, has 5 years to do it, countries negotiate in a multilateral way, they come up with an agreement, and then they phase in these tariffs. It's usually like a 10, 12-year process. We've done this several times, but we haven't done it for 30 years. The whole global kind of renegotiation process has broken down. So maybe what we have right now is a push that might be get us over the hump of going towards closer trade. Now, I will say we've been at moments like this before when it looked like tariffs were kind of going up and going to stay up forever. So we had a trade embargo in China in 1950. We had all communist countries. We jacked up tariffs in 1951. There's the chicken tax, which still is in effect. You guys know that's why SUVs that come into the U.S. pay a 25% tariff from 1964. And then there's a Nixon tariff of 10% across the board in 1971. And then we know Reagan did some things with constraints on trade. So we've been through moments when it looked like the whole world trading system was going to fall apart. I think we don't want to overreact to what's happening. All right, so let me just put some perspective on how much trade has grown. This is just a graph of U.S. trade as a share of our consumption of goods. You can see in the 60s it was about 10%. It's up to about 40%, and we've not kind of grown since the Great Recession. Now, the main source of this growth, we think, is tariffs have fallen over time. And here's a series of U.S. tariffs. You can see tariffs are pretty low. They're about 2% before the first Trump tariffs. They shot up to about 3.5%. Most of that is on China. But then if you go back in time, there were these spikes in the past, right? This is the second spike in 76 is a Ford tax, and then in 71 is the Nixon surcharge. Right now we're looking at something that's going to push tariffs up, and we don't know if this is going to be something where we're going to stay up for good or if things are going to come right back down. My guess is the way the markets responded, people think we're going to come right back down. Here's a longer-term perspective of these tariffs. Just follow the blue line. I showed you 1960 on, but if we go back in time, tariffs were really, really high in the U.S. history, up until they sort of drifted down until the Civil War. With the Civil War, they shot up again. Why? You had to repay your debts, and the way we raised revenue was by tariffing goods. The federal government was relatively small. Things fell. They stayed relatively high, and then right around World War I, we dropped tariffs again when we introduced the income tax. And then things went up again in 1920. We've been very fortunate having low tariffs for a long time, but there's a long history of kind of moving tariffs around in different ways. So the question is going to be, are we going to go back to something like this, or will we kind of continue going down closer and closer to zero? So let me just talk a little bit about how tariffs are going to affect the U.S. economy. Probably the most basic thing you hear people talk about is they're going to raise the price of goods, right? So we hear, suppose we look at electric vehicles coming from China. Biden puts 100% tariff on those last September. What's that going to do? Well, if the price of the good is, P, we're going to add 1 + 1. It's going to double the price, right? How does that sort of work through our system? Well, there's a couple things that could happen. What we're trying to do is tilt demand away from Chinese goods, Chinese EVs in this case. And so a couple things could happen. If we're buying less Chinese things, the exchange rate, the dollar could appreciate, making all goods that didn't get tariffs cheaper. That's kind of what happened in 2018. So you can think we raised tariffs on a bunch of goods. Maybe that's going to depreciate the yuan, and then that's going to make it cheaper to buy iPhones or something like that. The other thing we could see is firms might change their markups. That's that change in P. All those things are going to kind of work through the system, and they're going to depend upon what happens with the rest of the economy, if the rest of the world retaliates or not. And then when we do that, we're going to shift away our purchases from these goods. And how much we shift away, we'll call that like something called the trade elasticity. And this thing's a really complicated object. And let me tell you a little bit about this. That's that epsilon. So what can happen? Well, in the short run, you guys know exactly what's going to happen. If I tell you tariffs are going to go up, what are we going to do? We're going to run out and buy cars, or we're going to import a bunch of stuff. That's what we're seeing happening, because inventory management decisions really dominate our short-run behavior. And so if we think tariffs are going to rise, stockpile. Bring imports into the country. What's that going to be? It's going to be like a sugar rush for the economy. And then once we get all this into the country, we'll have a little bit of a hangover, okay? Likewise, if we think the tariffs are going to fall, right, we have these 90-day pauses, maybe tariffs are going to go up more in the future, or maybe they can come down. Well, if tariffs are going to fall in the future, people are going to kind of hold off on buying things. We'll have a little bit of lull in economic activity. This is what we see all the time when we change tariffs, and we do this all the time with tariffs. And this is currently a key force that's affecting the economy and making it really hard to understand the state of the U.S. economy. So trade was up through March, more so for imports. So we kind of, Trump's goal was to reduce the trade deficit. It's exploded in the last 3 months because of these forces. It's not been fully captured in the inventory measures that we see in the data. I think Jim will maybe show us a picture about this. And actually, the economy has kind of picked up growth over time. So let me just show you these pictures. So this is a measure of the U.S. trade balance, exports minus imports. We've been running roughly at 5%. This is divided by sales. And then the vertical line is when Trump was elected. You can see it was roughly 5%. And then starting in December, January, February, March, this thing has widened tremendously by 3% of GDP, or 3% of my measure of sales. That's much bigger, or roughly about the size of how much we kind of the goods we brought in during COVID. This is a really big shock. Likewise, this line right here is how much trade we've brought in. Actually, tariffs, in anticipation of tariffs, people are buying a lot more foreign goods, just relatively more imports. So this stuff is kind of taking off. All right. We can drill down to individual countries and see what's happening. So this is what's happening to like all of U.S. imports. You kind of saw this picture. If we go to Europe, imports have exploded the last few months. And we have extra data on China going through to April, and we've seen things have just collapsed. They've fallen off. Part of this is because people stockpiled ahead of time, and now this is kind of the hangover part. All right, so trade is kind of telling us people are kind of reacting to these tariffs in advance. You can't just wait until the tariffs happen. Everyone's being proactive. And this is industrial production. This is a measure of how much we're producing. Industrial production was pretty flat, maybe drifting downwards. Then we've got the election line, and we've seen a big surge, okay? It's grown from about 2%. That's a pretty big boom. It's not forever, right? Again, we're all rushing out to get things before these taxes go into effect. But you see similar activity in Canada, Germany, lots of different countries. So this is going to make it hard to really understand the state of the economy at different moments in time. So that's kind of how the short run of tariffs are going to affect the economy. If we go to the long run, well, there's other margins that are operating. So think of some of you probably run businesses, and you're thinking about a supplier that you're getting an input from, and the tariff goes up, and you're thinking, it's 10% more expensive, but if it's only going to be for a couple weeks or a month or a year or 2 years, I'm not going to find a new supplier, or I'm not going to look for new customers. And so a lot of what our people's expectations are for how long these tariffs are going to be in place are going to really determine how the economy evolves. In the first Trump tariffs in 2018, people sort of didn't do that substitution. They didn't look for lots of new suppliers. And so what we saw was trade didn't really fall as much as you would have expected to. Only when Biden came into office and didn't lower those tariffs back to where they were before did people realize, oh no, these are kind of here to stay for a while. And so that's when we saw this substitution. But this pattern happens all the time. And actually, when we look at U.S.-China trade, this has been the main feature since 1971 when we started trading with them again. So let me show you like a picture of how we've been the tariffs on China. So what is this? This is actually a funny picture. This is the median tariff, but the inverse of it. Why do I do the inverse? Well, this is basically telling me if I spend $1 on a good, how much money of that good do I actually get? So 0 means I spend $1, I don't get any of the good. $1 means I spend $1 and I get all of the good. The tariff is 0. All right, so now you have it. 1949, this measure, about 85%. 1950, the embargo is in place until 1971. Actually, you can't buy anything from China. What I learned from watching Forrest Gump is that the embargo was lifted in 71, Nixon, and then they basically got pretty high tariffs. That's why that number's kind of low. And then in 1980, we lowered the tariffs again. And then they were pretty low for a while. And then we have the Trump tariffs, Trump 1 tariffs that Biden kept in place. And then we have what's happened recently. So you can see, historically, kind of this inverse tariff is not as high as it's been, as low as it's been, if we go back in time. And that red dot is kind of the median inverse tariff that we had yesterday, and now I've put us back to where we are. So we have actually some experience with changes in trade policy on China. The 1981 was a big one. That was actually when we shifted from recognizing Taiwan to China. And so we can look at how people substituted away, and likewise, substituted towards Chinese goods, and we can look at how people substituted away in the first Trump tariffs. So here's something we call a trade elasticity. What this tells us is, given you change tariffs, how much do you change, how much goods you buy? So if you look at that, this is, zeros when we change tariffs. That first line is -3. So if I raise tariffs by 10%, we buy 30% less of the stuff in the first year. And then over time, we buy even less and less and less. Or if the tariffs go down, we buy more and more and more. So this whole path depends upon kind of the decisions that firms are making to find new suppliers, get better inputs, and go on from there. It's also depending upon how likely people think the tariffs are to stay in place. And so what we can see from understanding like the way that firms behave in trade markets and the way that this trade evolves is we can recover what people think were expectations at different moments in time. So let me show you for like the last Trump tariffs. All right, so let me tell you, this is a wild line. Look at the blue line right there. That blue line tells you, starting from 2015, where did people think tariffs on Chinese goods were going to go? Okay, they were pretty low, around 3%, but there was always a risk that we wouldn't be in good relations with them, and people expected them to go up eventually. When Trump came into office, initially we didn't see much action, and then in 2018 he raised the tariffs. That's that black line. The black line is kind of the path of tariffs up through 2024. And the red line is what happened, what people thought based on behavior of where tariffs were going to go. So they went up, but people thought they were going to come right back down. He was trying to get a deal. And as time went on, this whole path has shifted out. And so now people were, at least through the election where we kind of finished estimating this, people thought tariffs were going to eventually come down, but the path of which they were going to come down has changed a lot over time. A lot of this is what goes into the decisions that firms are making to decide whether they trade more to get their inputs from China or sell things in the US. So let me take a step back, kind of took you through a little bit of history here. Now I want to just talk about why do countries use tariffs, right? There's really several arguments. The first is going to be that thing I talked about influencing the terms of trade. If we kind of shift demand away from foreign goods, we can kind of have the exchange rate appreciate. We get more stuff. This seems to be like a strong argument in the Trump administration. We can also raise revenue, and then we can adjust to balance of payments problems. You've heard so much about the trade deficit, okay? There's two other reasons, or I'd say more kind of less complicated reasons. One is this national security, and the other is you've got some friends you want to benefit, right? That's always the complicated one. That's the one where tariffs can become a problem because there's so many products you can put tariffs on, and that's one of the things we worry about. So let me go back to tariffs as revenue. So as I said already, tariffs were the main source of US revenue until we had the income tax in 1913. Recent tariffs have raised more revenue, about $300 billion. Nothing to sneeze at, right? I mean, that's roughly the amount of student loan debt relief we gave the last 4 years. I just read that there was an extra $16 billion in revenue on tariffs this last month. And here's just a picture of the tariff rate and the share of tariff revenue. That's that black line. So if you go back to 1929, roughly share of revenue. So roughly 20% of federal revenue came from tariffs. That's been pretty low since government became big in the late 30s. And as the tariff rate has come down, that's the red line, actually tariff revenue has grown because there's a couple things going on. One is even though the rate falls, trade grows over time. We're in Santa Barbara, you guys know about the Laffer curve, right? There's gonna be an optimal tariff for raising revenue. And then that's that blue line, it's telling us trade's kind of grown a lot. And so the tax base has grown a lot. All right, so again, once we start thinking about tariffs as revenue, we need to think about if we have tariffs, can we cut some other taxes? And so we've been doing some work trying to understand that. So let me just tell you, if we look at our current tariff rates before, I don't know, a couple weeks ago, months ago, 6 weeks ago, let's say, the amount of revenue we could get from tariffs going into the future would be about 15% of GDP. Not a lot, but nothing to sneeze at. For comparison, corporate income tax, roughly 3 times that, okay? If we start thinking about tariffs as revenue, probably you could get up to another 20, 25%, 40%. And then what you do with that tariff revenue, you've got to think about, trading off those different distortions in the economy. I don't want to get too far. The key thing is what we do with that revenue. If we use it to subsidize investment, encourage people to go to work, the tariffs might not be as costly. If we give out a tariff dividend check, that's not very good because it's not going to create much incentive to work. And importantly, when we raise tariffs, a lot of that's going to fall on capital goods. And if we're thinking about one of the reasons why we're doing this is to build more infrastructure, improve the amount of capital we have in production, that's not going to work. A lot has been discussed about the trade balance as a reason to have tariffs in place. So the U.S. trade balance as a share of GDP has been roughly 3% for the last 15 years, maybe a little bit less than that. The consensus is that that reflects good growth opportunities in the U.S. That's why people come here to work, people come here to invest. It also reflects poor savings by Americans, partly because they have good growth opportunities, but also reflects really a real strong desire to save in the rest of the world, partly because they don't have good growth opportunities. So if we look at China, which is a really fast-growing economy, it's sort of puzzling to us that we don't see China sucking in a lot of capital. So it has to be they're either forcing savings or they're kind of over-accumulating. So these forces are always operating in the economy. They're intermediated by how much trade we have. So a closed economy can't run surpluses or deficits. An open economy can. Tariffs can help in this adjustment. Obviously, if we go to no trade, there'll be no trade deficit. I don't think that's the outcome anyone's looking for, but there's certainly a margin that people can use. Let me just say these are really exciting times as a researcher. Creates a little bit of anxiety, I think. But we should have some perspective that we've been through this before and the economy has survived just fine. There's going to be some reallocation, most likely. It would be nice if this was connected to the whole fiscal process with Congress. Maybe even linking this tariff revenue to tax reform would be helpful. But it'll be interesting for a while, I think. So thank you.
Yep.
Thanks, Peter.
Thanks, George. Appreciate it.
Thank you.
What should tariffs be exactly? 0? What do you think tariffs should be as an economist? Thanks, George. I really appreciate it.
Yeah, I don't think 0. I don't think 0.
Next speaker is Jim Bullard. Many of you remember Jim came a few years ago when he was president of the Federal Reserve Bank of St. Louis. He is now the dean of the School of Business at Purdue. Hopefully this time he can be a little more candid about what he thinks the Fed is going to do, because they're not when they're working at the Fed. Anyway, please welcome back Jim Bullard.
Thank you, Peter, and thanks everyone for being here today. I'm looking forward to a rousing session. This is going to be more on tariffs because it's the topic of the day, but mine's a little bit more about Fed policy, interest rates, the dollar, and other aspects that I want to touch on here. So this is definitely Jim's view of what's going on. We'll talk a little bit about initial conditions. I do think it's important to keep in mind that coming in, things looked pretty good, so I'll talk a few slides about that. You've got these tariff threats that George talked about a little bit. I've got a little bit on that. I've got the game theory aspect. I've given this elsewhere, and the students love the game theory, so we'll talk about that. And the Jerry Maguire problem that could be looming here. If you don't recall, Jerry Maguire, he was a sports agent. It's a movie from the 90s. You guys know that. It's California. He was a sports agent, and I forgot what happened. He either got fired or something, and then they're splitting up from the firm. But the firm is scrambling to get his athletes, and he's scrambling to get the athletes. And in the end, he gets only one, but as I recall, the best athlete. So there is a Jerry Maguire problem here that could develop on the decoupling side, so I'll try to cover that a little bit. There's a last trade war, which was 2018-2019. I was on the Open Market Committee at that time, so I lived through that one. A little bit about the dollar, a little bit about interest rates. These initial conditions are good. So I just wanted to illustrate that coming into this year, after the election, these numbers here in the middle of this page are the ones that were projected for the end of 2025 by the Open Market Committee. So the point of these is that these are very benign numbers. 2.1% growth would be very close to the potential growth rate of the U.S. economy. Inflation at 2.5% would be a little bit high, but it's been coming down. And unemployment at 4.3% would be very close to what many people think is the natural rate of unemployment. So this is about as steady state as it would get for the U.S. economy. That was the projection as of December of 2024, so coming into the year. And other real-time indicators about the economy, including about inflation, aren't really showing much of a ripple so far. So I'm going to show you three charts to make this argument that the initial conditions are good, and that means that whatever the trade war does, you could be coming in on a rocky path or something, and then the trade war is just enough to throw you into recession. I don't think that's where we are. We came in on a really good path, so you've got some room to maneuver. Here's a chart about from the Daily Shot, which is about the unemployment rate. This is a way to control for the seasonality. Those brightly colored lines are all the different years. The blue line is this year. So this year basically looks like all the other years that were successful years. The lines that go off the chart were 2020, the pandemic, and 2021 as unemployment came back down. So this is weekly unemployment insurance claims are often considered one of the best real-time indicators of what's going on. You don't see anything here. And this goes through last week. So far, so good. This is the GDP number that came in. Some of you may recall the GDP number was negative. That doesn't sound very good. Negative 0.3% growth. That's the dotted line in this picture. That's why that looks like it's tanking. So if you just looked at that all by itself, you'd say, oh my God, I guess the world really is coming to an end. But no. That's not what's going on. As George was talking about, there's a lot of front running because everyone hears the news, and one of the most interesting things about macroeconomics, and the reason why it's harder than physics, is that your particles have a mind of their own. And these particles definitely had a mind of their own. They saw the tariffs coming and said, I'm going to front run that, and I'm going to import a lot of stuff before it gets taxed. So the way that shows up in this data, that should have shown up as inventory buildup in the U.S., but it doesn't quite work that way, and so that dotted line went negative. But Wall Street wasn't too worried about this. That horizontal dotted line there shows 3% growth. This is from MRB Partners via the Daily Shot, and so the story is that if you just look at consumption growth and investment growth in the U.S. and forget about the inventory part and the trade part, you get 3% growth. So a lot of times that's considered sort of a better measure of what's fundamentally going on in the economy, and that's a good number. So again, good initial conditions for the U.S. economy. And a lot of people have said, well, the tariffs are going to raise inflation, but the market doesn't think that. The market thinks this. In this picture, this goes back to 2021 and goes across all the way out to the current number. This should be daily data, actually. It might be weekly data, weekly averages. This is the TIPS expected inflation rate. So this is actual people on Wall Street betting on what they need to be compensated for the inflation that might be out there in the future. And the break-even is about 2.4% over there on the right-hand side. And you can see that this has not skyrocketed. Nothing's happened so far. So far, so good. Markets are not expecting a lot of inflation. So obviously, the incoming administration campaign on leveling the international playing field with respect to trade, but everyone knew that. But nevertheless, when you got to April 2nd, the announcement surprised everybody. It surprised Wall Street. It alarmed everybody. You could say, well, that's a negotiating tactic. You take an extreme position at the beginning and then see what you can get as you negotiate going forward. But these were at levels not seen since the early 20th century. So Wall Street didn't like that. Equity markets sold off, much to many people in this room probably were very familiar with that. And recession probabilities moved sharply higher. So let's look at those pictures. This is similar to the one George had. This is from Capital Economics via the Daily Shot. This goes back to 1890. This chart made the rounds pretty quickly after April 2nd. So as George was saying, tariffs used to be high. 1890 is the McKinley era, President McKinley, for those of you that are not recalling your U.S. Presidential history. And then that peak there around 1930 is Smoot-Hawley. I'm going to talk about Smoot-Hawley here in just a minute, considered a contributor to the Great Depression. And these, this is an effective tariff rate, that looks higher than Smoot-Hawley. Wow. So Wall Street didn't like that and sold off abruptly. Here's the recession probability on Kalshi as of April 22nd. This number has come down in more recent data, but this just shows you how much this went up in response to the announced tariffs. 60% chance of recession in the next year, shockingly high. I will say something, though, about this chart. Recession probabilities are kind of high on the left-hand part of this chart. So on the left-hand part of this chart, that goes back to August of last year. You might recall there's a bit of a recession scare in August, September of last year based on some weak labor market data. And this same measure had the recession probability between 40 and 50%. This is a betting market, so there's a daily betting market. If you want to bet on it, you can do so. And this came way down after the election and into the first of the year, mostly because the data was way better. Some of the data got revised, and people weren't sure what the trade policy was going to be. But as it became clear that we're going to get a lot of announcements on trade, this certainly climbed precipitously. So here's the game theory. So let me just talk through this for a minute. The U.S. is is the role player, and they can play low, the L, which would be low tariffs, or they could play high tariffs. And the rest of the world is ROW, and they're the column player here, and they can play low or high tariffs. So the Trump administration thinks that we are in the upper right box there where it says current state benefits rest of world. That's what they think. So they think the U.S. is playing low tariff, and the rest of the world is playing high tariff. And especially if you consider non-tariff barriers to trade, I think most economists would probably agree with that assessment. A typical country around the world doesn't really like the idea that they're going to compete with big American corporations who are very efficient. They ask for protection from their government, and they might get it directly in terms of tariffs. They might get it indirectly in terms of bureaucratic blockage of trade with the U.S. So that's the current state. Whether it really benefits the rest of the world is a great topic for a lecture. I'm not going to go into that, but it's perceived as benefiting the rest of the world. The low box there on the upper left is free trade. You could probably never have totally free trade, but free-ish trade, and that would benefit everybody. There's nothing wrong with the free trade theorems. You're better off allowing all the trades to occur that people want to occur. So that's where the free trade theorems would come in. The lower right is both sides playing high tariffs, so that would be like Smoot-Hawley. So just let me refresh you about Smoot-Hawley. In 1930, the Congress started, in 1929, there's a famous stock market crash. There was a rally after that, now called the Fools Rally. And then in the first half of 1930, the Congress started talking about putting tariffs on at a high level, and they eventually passed that bill and sent it to then President Hoover's desk, and he signed it. And that's one of the suspects about what caused the Great Depression. There are others. Milton Friedman said it was the Fed. Of course, I don't like to blame the Fed, so I think Smoot-Hawley is a better thing to worry about. But everyone would say this is a problem. And the other countries, in that case, the other countries looked at that and they said, okay, we'll raise our tariffs too. So you just got, everyone went up, and all the trade basically dwindled down to very low levels or even to zero. So that's the Smoot-Hawley outcome. So what Wall Street was worried about was that you might get that kind of outcome. You might get, other countries just say, look, we just can't work with the U.S. anymore. We're just going to put up high trade barriers, and we're going to look for our, markets for our goods elsewhere, and that's going to be the end of it. So if that was the end of it, you would get trade collapsing, especially with the prohibitive tariffs that you're looking at between China and the U.S. And if you had that, then that would be a very bad outcome that would damage the value of the equities being traded on U.S. markets, and you'd have a global recession. This is where the Jerry Maguire problem comes in. A version of this is that it's China and the U.S., and if China and the U.S. just leave their tariffs very high, all the other countries will be scrambling, just like they were in the Jerry Maguire movie. They'll be scrambling to decide which side they want to associate with and create a deal that way. And so there's some of that going on if you read about it in the papers. My experience in reading and thinking about the Cold War was that you had a very similar thing going on. You had the Soviet Union and the United States. Many of the other countries were very shrewd about trading off the Soviet Union against the United States. They wanted to see, well, what are you going to give me if I join your side? And you get that kind of competition going on. So I call that the Jerry Maguire problem. There was a trade war in 2018, 2019. It was a war of words between China and the U.S. It drove higher uncertainty, and I've consistently told audiences it's that which can send you into recession. No one wants to make $1 billion investment in some country if they don't know what the trade rules are going to be. So in corporate boards all across America and all across the world, and some of you are on them, they're all sitting there saying, why don't we hold off on our $1 billion investment until we find out what the rules are going to be? So you have this pulling back. That's a very clear dynamic that's going on. And in 2018, 2019, that eventually slowed down the U.S. economy. in the summer of 2019, and the Fed responded to that by lowering the policy rate. So you could get that dynamic today. I would stress, I lived through it. Inflation was below target at the time. We might have welcomed a little bit of inflation at the time to get up closer to the target. We didn't really get that. By our preferred measure, inflation actually declined in the first half of 2019 as this trade war was going on. So I think the inflation part of this story that's dominating in the media, it has to be reconciled with what's going on here. This time you do have threatened tariffs, which are much higher than they were in 2018, 2019. A lot of people tell me that the dollar is going to lose its reserve currency status. That's because the dollar has depreciated recently. This has bounced up just a little bit here at the end of this chart. This chart goes back to 2022, and I think you might interpret that as a squiggly line. That would be the scientific term for that. But the point is, yeah, you've depreciated a lot in 2025 here. That's about 8%. When this chart was drawn, this is a trade-weighted value of the dollar. But you see movements like that since 2022, 2023, 2024. So it's not enough yet anyway. It's not enough, nowhere near enough to say, oh, all of a sudden no one wants to hold the dollar globally. I don't think so. So you got a ways to go if you want to make that argument here. If you go back further, the dollar was actually weaker. So you'd have to go quite a bit lower just to get to levels that you might have seen pre-pandemic. And then the last point here is on rates. What are rates going to do? That's the classic question. And I just wanted to make this point with this chart. So this is a yield curve chart. So we'll take the 30-year Treasury yield and we'll subtract off the 2-year Treasury yield. The 2 years, at the short end of the curve, more related to Federal Reserve policy. The 30 years, the long bond yield. If those are inverted, that's usually a recession signal. So if we subtract one from the other and get a negative number, that would be a recession signal. And we had that here in 2023, according to this chart. Over on the right-hand side, which is 2025, excuse me, this has actually been going up. So what the heck is going on? If this is a recession indicator, and it's a powerful and very accurate recession indicator, then why are the Kelshi guys buying that in that probability chart? They were all saying there's 60% probability of recession. This is saying there's not much probability of recession. So, and the other thing about this chart is that this period here in the, oh, I can't do that, huh? Okay, I'll do this. In 2023, that period, this thing's negative. Why is that? That's because the Fed raised rates enormously in the second half of 2022. That was the time we did 475 basis point increases in a row. I was a big advocate of that. And markets thought we were going to have a recession. I said we weren't going to have a recession, but markets thought we were going to have a recession. And so this was inverted all through that period, all through 2023, and only reluctantly went positive in 2024. But why is this over on the right? Now everybody kind of thinks we're at higher recession risk now. Why is this thing going up? Well, maybe something else is going on that's making the longer-term rates go up, and the something else is a debate in Congress over U.S. fiscal policy, and they have to decide between, and they're obviously going to try to pass the bill here. They're trying to decide what the level of taxation should be, what the level of spending should be, and what the level of borrowing should be. And I think, and my reading of it is, they don't really want to change the taxes, which means keep the old tax cuts in place. And they don't really want to change the spending either, which sounds like you're going to borrow a lot of money going forward. So the Committee for a Responsible Budget says that you're going to send the U.S. debt to GDP ratio to 150%. It's depending on how you measure it, it's 100% today or 120% today. So, so it's got markets might be reacting to that and might be saying, well, if that's what you're going to do, then I'm going to demand more of a risk premium for longer-term lending to the U.S. Government. So that's one interpretation of this story. Okay, let's finish up. I said that, just so you don't forget what I said, because I don't like that, so don't forget what I said. So initial conditions are good. That gives us some cushion. So that's probably good news. That might keep us out of recession. The threatened tariffs were definitely higher than expected and at Smoot-Hawley type levels, so that's pretty high. We've got this game theory going on between the rest of the world and the U.S. and bilaterally between all these countries. It's not clear how that's going to play out. There's this decoupling risk between China and the U.S. One way to think of that decoupling is that you are going to get some decoupling. I mean, the Treasury Secretary even said today, for some goods, we're not going to be trading with China. So you get some decoupling, but how broad would that be, and how much does that set up a Jerry Maguire problem? The trade war in 2018-2019 gives you a roadmap. You did get deals made. Inflation didn't really take off. Growth was slower, and the policy rate moved down. So that might be what happens this time, but this is a bigger trade war than what we had at that time. And finally, longer-term yields today could be pricing in U.S. fiscal situation more than in the past. So thanks. You've been a great audience, and I look forward to seeing many of you later.
One question. Okay, so you mentioned that they did cut rates in 2019. You were there doing that. You just mentioned that this is bigger. What's your expectation for what you think the Fed is thinking right now and where they might go?
I think the Fed's in great position today because they already lowered 100 basis points in the second half of last year. That brought rates down to a lower level. You still got inflation a little above target, so you can leave the policy rate where it is, see what happens. And then from there, they've got some possible rate decreases in the future. That's pretty good for markets. So that's a pretty good place to be.
Okay, great. Well, thank you, Jim.
All right, thanks a lot.
Okay, next up is Lee Ohanian. Lee is a professor at UCLA, and he's going to tell us all about big issues in housing in California and maybe why your houses are so expensive to live here. So, Lee.
Thank you. Thank you, Peter. I'm delighted to join you today and share some ideas with you about two of our most pressing challenges that we face in California: housing affordability and homelessness. And I promised Peter I would do this in under 20 minutes. So I'll begin with housing. And to frame this, I'll discuss a couple of statistics, one of which is that the median California home is priced at about $884,000. This is about 115% higher than the median national average. These data are from the California Association of Realtors and the National Association of Realtors. And in terms of affordability, you can just imagine what that means. The California Realtors Association estimates that only about 16% of California households can afford that median-priced home in our state, whereas about 50% of households across the nation can afford the median national price home. And of course, in Santa Barbara, it's much more challenging. We have a $1.4 million median priced home in the county, and while I haven't seen specific estimates for affordability locally here, I suspect is probably somewhere in the 8 to 12%, 8 to 12% range. Now, it's tempting to conclude that housing costs in California are high simply because of just the remarkable place we live in with the amenities that we enjoy, for example, today. But the amenities have always been with us. But for many years, California housing was much more affordable than it is today. So let me show you a figure. And in this figure, this bar here is that 115% price premium between California's median home and the national average median home that we have today. And then these other bars, this is 1970, 1960, 1950, and 1940. And you'll notice that the California housing price premium in those years was much, much lower. It averages only about 28% higher than the national average. And what's particularly striking is that population growth during this period in California was just remarkable. Our state grew from about 7 million in 1940 to about 20 million in 1970. So we tripled the size of the state, yet despite that enormous increase in demand, the relative premium really did not move very much. When we look at what's going on today with this enormous premium, the state's population really hasn't budged much. It's only grown about 2% in the last 10 years. So this is not simply a story about everyone wanting to live in California. Now, what happened? These data really just jump out at us and say, what happened? Well, housing costs essentially mirror the cost of building. And a big difference between today and what we saw during that 40 to 70 period is that building regulations rose enormously during that period of time. And that drives up building costs, and when building costs go up, housing costs go up. And there are many regulations that have come into play over the last 40 to 50 years. One I'll focus on today are environmental regulations, including the California Environmental Quality Act, which was passed in 1970. And this was shortly after we had the oil spill out in our channel in 1969 that made world headlines. And the idea behind CEQA, C-E-Q-A, the idea behind CEQA was give us tools so we could be responsible environmental stewards for today and into the future. And it's certainly a very well-intentioned law, but sometimes that law is used to prevent or delay development. And I'll give you just what I think is perhaps the most telling example, which is a proposed development called Newhall Ranch, just outside Valencia, about 70 miles from here. And in 1994, developers submitted plans for this community called Newhall Ranch. It was going to be literally a new city of 60,000 people. It took 27 years to build the first homes. Not until 2021 were the first homes Newhall Ranch built, because there was just a series of regulatory barriers and environmental lawsuits that developers had to deal with during this period of time. My understanding is that perhaps more than one developer was bankrupted through this process. You can just imagine how such a time delay, as well as legal costs and expenses, would drive up housing, and that's exactly what we see. These homes are now for sale, and they sell for as much as $2.8 million. So we want to facilitate development. We want to build efficiently, but we have some impediments that make it very difficult to do that. Now, policymakers throughout the state, they understand very well we face an affordability challenge. And in fact, over 100 new housing laws have been passed in Sacramento over the last few years to try to create new housing and reduce costs. But they haven't really moved the needle because unless you reduce the cost of building, we cannot legitimately reduce the cost of California housing. And to put that in perspective, there are fewer private building permits being issued today than there were before many of these laws were passed. So these laws are just missing the mark. What we really need to be able to do is to reduce the costs of creating new housing. Now, another issue that I don't think has worked very well within our state policy planning process for housing is what's known as the regional housing needs allocations. And the reason I don't think it has worked very well is because it's very much a top-down framework in which Sacramento tells regional governments how much housing each region needs to build. And then there's a back and forth between Sacramento and regional governments about where that housing is going to go. And what another issue that, that concerns me is that being a top-down program, it reduces the amount of local control the communities have over how they wish to live. And it also results in low-income housing being placed into locations that just don't make a lot of economic sense. So, for example, up in San Mateo County, Atherton, California is, I believe it's the most expensive zip code in the country. The median home price is about $7.8 million. Atherton is trying to figure out how to build new housing, including apartment units in that location. And because Atherton is such an affluent area, households with incomes in excess of $200,000 are going to be able to live in subsidized housing. And if you think about a household with over $200,000 of income, they're very close to the top. So this just doesn't make an awful lot of economic sense. But there's a better way, in my opinion. So let me just spend a couple of moments and talk about that. 3, what I think are kind of simple, common sense steps towards building new housing. The first is that we need to revisit our regulatory framework, such as the California Environmental Quality Act, not to eviscerate it, but to make modifications where it makes sense so we can reduce building costs in order to reduce housing costs. If we can't reduce building costs, we simply cannot reduce housing costs. Some developers I know have told me, developers who work in California and also other states, they've told me that in some areas of California, building costs can actually be twice as high as they are in neighboring states such as Arizona and Nevada. Another issue is that we need to facilitate building in areas where land is somewhat more affordable. Most of our state is unoccupied. About 90% of our population in California lives on just 5% of the land. So there is room to spread out. And to give an example, the fastest growing community in California over the last year is a community called Shafter, which is about 20 miles outside of Bakersfield. Land is much more affordable there, and as a result, they're able to create new housing with a median price of about $370,000 compared to the state's average of $884,000. And when it comes to urban areas and thinking about housing there, if I look at Los Angeles, there are about 33,000 vacant lots in LA, some of which have been vacant for as many as 60 years. Now, these are eyesores, so let's prioritize building in those locations. And that will, 33,000 vacant lots can substantially expand housing supply in Los Angeles. But we can even do better than this. We can do better than a $370,000 home, which is what we're looking at in Shafter, California. We can also lever the efficiency of modern building technologies. So we can now build homes from start to finish within factories, exploiting the cost efficiencies of mass production And this can economize on building costs by at least 50%, and I suspect here in California maybe closer to 60 or 70%. And my estimates suggest that we can create housing at about $250,000, perhaps less than that, provided we're building not so close to the coast where land is just extremely valuable and expensive. Now, this to me seems all like very simple common sense. Sacramento is a different animal. I know the attorney who shepherded Newhall Ranch through many years of that complicated litigation process, and what she has told me is that that virtually almost every day of the week, her office in Sacramento, almost every day of the week, she's in the state capitol trying to get movement on some of these regulatory issues. Unfortunately, it's been slow going. Okay, let me talk a bit about homelessness. Homelessness is rising within the state, despite the fact that we've spent an awful lot on it. Right now, there's the official number for California homelessness is about 186,000. That's up about 60% since 2015. The Legislative Analyst's Office has been looking at other data sources, and they think that the number of homeless might be as many as 400,000 measured throughout the year. That 186,000 number comes from a one-night point-in-time count that's done each year, and it's widely agreed that this potentially misses many of the homeless. And it's not as if we haven't spent on this problem. We've invested $37 billion in homeless programs and housing since 2019, and yet homelessness is increasing. So again, I feel like a lot of my talk here is asking what went wrong. So here we have another time where we're going to ask what went wrong. And I think there's really two issues here that are noteworthy. One is that our homelessness apparatus merits better stewardship, oversight, management, and accountability. And so what I've put here are some quotes from a recent audit of California homelessness spending by the state auditor's office. And you can read faster than I can talk, but the quotes are really quite damning in terms of the lack of the application of standard cost accounting, financial reporting principles. And we're talking about just tens of billions of dollars here. And long story short, there's an awful lot of money where we just don't know where it went. And I think we all agree this is just unacceptable. But it's not just the California auditor. A federal audit was done of California homelessness spending, and the federal audit concluded that our homeless investments didn't have adequate fraud safeguards built in to protect the $320 million that we received from the federal government. And now this is particularly noteworthy after our Employment and Development Department was hacked for possibly as much as $32 billion as a result of antiquated IT architecture. The second issue is that, in my opinion, our approach to homelessness needs to be reframed within the context of what's a sensible scope of what we do, and also incentivize personal responsibility. I think of homelessness and protecting against homelessness as part of our social safety net. The social safety net is essentially social insurance that we would like to have, but we can't buy in private insurance markets. So we can go out and buy auto insurance, and therefore governments don't offer auto insurance. But we can't go out and buy unemployment insurance in private insurance markets. So we offered that as part of the social safety net. And any successful insurance program is going to explicitly define what life events or events are going to be covered, and also incentivize responsible behavior. Otherwise, these programs become unaffordable and they spiral out of control. Our program has become unaffordable. The budget has exploded. Some apartment buildings are being built for the homeless at a cost of $1 million or more per unit. And just keep in mind the median home price in the country of a little over $400,000, plus you have a yard to enjoy. Now, this is a picture of a mansion, an estate in Florida that's owned by Jeff Bezos. It's on a man-made island. It's one of, I think, only 40 houses on this island. The cost per square foot, for example, the costs I just mentioned to you, the cost per square foot of our most expensive housing that's called affordable housing or for the homeless, it's not quite at the level of Jeff Bezos' mansion, but it's not so far away. So when we talk about insurance or programs that incentivize responsible behavior, for an awful long time, our approach to dealing with homelessness was followed kind of two principles. One was called harm reduction, which is, as a society, we should accept substance use as a lifestyle choice, and housing first, which means we provide permanent housing to the homeless, irregardless of whether they're sober or not, or irregardless of whether they're entering treatment. And this is a picture of San Francisco. The image is taken, I believe that's the Lick Pioneer Memorial. The public library is on the right side. The UN pavilion is not far from us. This is a city that's just really just been overwhelmed with homelessness. So for a long time, I don't think our policies really recognize that there is a causal link between psychiatric disorders and substance abuse and being homeless. And you see that in the fact that we simply don't have enough treatment beds in place within California. So when we think about what we should do, we need to invest in treatment facilities and, in my opinion, prioritize treatment over expensive permanent housing, because we want these individuals to exit dependency. And we also should focus on reuniting them with family. This is oftentimes some of the most successful ways we can go about this. And we also need to improve our average K-12 schooling within the state. And not just teaching kids about the dangers of drugs, but improving average school quality. Only about 25% of California kids are proficient or advanced at grade level math, just about 1 out of 4. And some of those, if they're not going to get better education, will become the new homeless. And the human cost of this is staggering. Just in San Francisco alone, 3,462 overdose deaths in the last 5 years. Final remarks. We need to recognize that some who want to live in California, and particularly near the coast, don't have the economic means to do that. We can't realistically provide housing for all current and future Californians who can't afford to live in California. But we can create much more affordable housing so those without super high incomes can afford to live in California. And we also need to accept the fact that living in a free society, which we so dearly love, requires an enormous amount of personal responsibility and contributing to your community in some way. If our safety net is consistent with these ideas, then we can succeed at a higher rate, we can save lives, and I think we can improve the quality of life for all. Thank you so much.
One question for you. One question.
Yeah, absolutely.
That was great, Lee. Have you seen any movement on the regulatory front in the state?
So with respect to the California Environmental Quality Act, there's been all sorts of workarounds, and many laws have been passed modifying it. They just haven't really moved the needle. There is a proposal within Sacramento to exempt urban buildings from environmental review. I would prefer it if we simply continued with environmental review, but we just made it a lot more common sense so it didn't delay things so long and just drive up builders' costs. So it's glacial, but hopefully.
Okay, great. One more thing.
Yeah.
Do you think it's appropriate to wear tennis shoes at an event like this?
Well, only if we're supporting local business.
Thanks, sir. So, I know what you're thinking. He's wearing jeans and tennis shoes, and everybody else is dressed so nicely. I wore it for a reason. I've been asked many, many times over the last few weeks about trade, tariffs, and what that might do to our local businesses. So, I have this watch case. And by the way, a matching watch band. Comes from Nomad. Nomad is headquartered here on Ortega Street. They make watch bands and cases and other devices. I talked to them just recently. Everything they make comes from China. It all comes from China. Do they have plans to now move out of China? They do it at a cost. My jeans, Ace Rivington. You guys know Ace Rivington? Fantastic jeans store. Let me tell you how complicated this is. So they use California cotton. They take the cotton and they ship it to Italy. Italy makes the denim. The denim is shipped back and then shipped to Mexico to put it together. That's the process. Now you can imagine how tariffs are going to do this. These are Hokas. Deckers. Deckers used to be they used to make a lot of their stuff in China. They've moved over the years. They have a lot now in Vietnam. So it turns out, remember what Vietnam's tariffs were going to be? Huge. That's going to increase the cost. I think if we personalize it, we realize, hey, these are businesses we love here. We love them to be here. We want them to succeed. These are very, very competitive markets. Watch bands, cases, a lot of people are doing them. That's why I'm wearing jeans. I'm lying, but. So, quick economy overview. Jim talked a little bit about it. Until we had this great tariffs announcements, the economy was doing actually really, really well. GDP in Q1 fell a little bit, 0.3%. I'm going to come back to this because this is going to be an important thing that I'm going to mention, how to think about this decline. Inflation was subsided, as Jim mentioned, and we had a very strong labor market. So this is the GDP, real GDP decline, as you can see, fell 0.3. It had been averaging a pretty strong amount. What does that mean? It means that in real terms, this thing was growing at a little over 2% average over the last couple of years. That's the largest number, historically we see it growing at about 1.82%, something like that. So these are strong numbers. The economy was doing well. This is PCE inflation. Core PCE inflation removes food and energy. The blue line is useless. That's the monthly one that gets reported a lot. The green line is year over year. And the red line is a line that my blog mate and I designed. It's called trend inflation. I won't go into the details of it, but what you can see is it's fallen. It's still above the 2% target, but it's fallen. So, the Fed is in good shape overall. This is payroll employment change, 177,000. And as you can see, it kind of beat average over the last year or so. So all these things were doing well before the tariffs. Let me talk a little bit about the South Coast. South Coast, we've seen very slow growth, actually, in employment. It's something we should be worried about. Santa Barbara, we're not even back to pre-COVID levels, and it's still falling. So this is a picture of employment, private employment. I've set the number equal to 100 in the year 2000, and I have it for the U.S. That's the U.S. This is California. This is Ventura, and this is Santa Barbara. And what you can see, it's not like everybody has gone down. California and the U.S. have more employment now than they did before. We tend to be falling. So this is not a good sign overall. This is retail and leisure and hospitality in the U.S. And you can see leisure and hospitality, employment's above what it was pre-COVID. Not so true about retail, as we've all seen. What does it look like in Santa Barbara? Way different. This is retail employment in Santa Barbara. It's been falling since 2000, roughly. Leisure and hospitality, which has to do with a lot of our tourism, employment in that sector has been falling. So there's some issues here going on that we should be really careful of. So now I'm jumping all over the place. So I want to talk about facts. What are facts? Well, I really want to talk about how data are used and how it's misused, and not even intentionally. I'm going to give you two quick examples. One is the unemployment rate in Santa Barbara. And by the way, I'm not picking on any particular news outlet or person. And then I'm going to talk about what happened with the decline in GDP. So here's some facts. So this comes, as you can see, from the EDD, Employment Development Department here in California. And they put this out. And what you can see is, this is the unemployment rate. This is the civilian unemployment rate here for Santa Barbara. And let me do this. This is the Pacific Coast Business Times. I'm not blaming them. They're just reporting the facts. I'm not blaming Jorge, just the facts. What does it say? The unemployment rate in each of the tri-counties saw slight declines in March, a sigh of relief for the Central Coast as a whole after a very turbulent February. So you walk away and say, hey, things are pretty good. Things are pretty good. Well, this is going to be on our new website coming up soon, how we're going to look at data. And what you can see here, this is the Santa Barbara County, the MSA, and Jim mentioned wiggly lines. This is another one of those wiggly lines. This is the unemployment rate. Okay, so this is that data that was just reported, and as you can see at the end here, indeed, it's fallen a little bit. I'm going to blow this up in a second. If you notice, which no one ever does, it says data not seasonally adjusted. And you think to yourself, come on, who gives a shit about seasonal adjustment? You don't even know what it is. This is why we care. This is exactly why we care. And because we know, in certain parts of the year, in certain times, we know exactly, for example, in December, that employment goes up because it's hiring in Christmas. In January, unemployment goes up because we lay off a lot of workers, farm sector, etc. So what you really care about is relative to what it should be, used to be, last December, how are we doing this December? That tells us how we're doing. Well, what you can do now is you can click on seasonal adjustment. The problem is the Bureau of Labor Statistics nor the EDD seasonally adjust local data like this. They don't do it. it's expensive to do it for every county in the US, but the Forecast Project, we do it. And what you can see is, yeah, sure enough, look at the end line there. The blue line fell. Unemployment rate did fall. But no, it didn't. The seasonally adjusted one said it went up. So actually, unemployment got a little bit worse in Santa Barbara County, not better. So it's not a sigh of relief, and simply by looking at the data that one really should be looking at. But again, the facts that reported were true. That was what the report said. But it really wasn't the right data to give an answer to the question, how are we doing for the unemployment rate? Oh, that's that article, that's that, fine. Here's a second one. So this is from the BEA, Bureau of Economic Analysis. That's who reports GDP. And if you ever took any economics, and you hated it, of course, but you might have seen this thing. What this little equation says is, on the left is gross domestic product, say, or income. Gross domestic product is equal to the stuff that we produce and consume, et cetera. So on the right is consumption, that's the C, plus investment, plus government spending, plus net exports, X minus M. So you don't need to know much math to do this. You would say to yourself, well, if M goes up, if imports go up, then GDP must fall. Kind of makes sense. But it's wrong, unfortunately. But guess what? Almost everybody gets it wrong. It's just unfathomable to me. So who gets it wrong? Well, this is the Bureau of Economic Analysis report. What does it say? The bottom line. The decrease in real GDP in the first quarter primarily reflected an increase in imports, which are a subtraction in the calculation of GDP. They said it. This is the Bureau of Economic Analysis, just told you that imports were the cause of our drop in GDP. This is the Wall Street Journal. All of you read one of these, I know it. Imports subtract from the Commerce Department's calculation of GDP since they represent spending on foreign-made goods and services. So subtract means, you know that negative sign thing? That's what subtract means. This is CNBC. Gross domestic product fell at a 0.3% annualized pace, largely pushed by a surge in imports. It's all wrong. Imports have no effect on our GDP. How about that? Anybody believe that? Damn well better. Why is it? We import a Samsung TV. What happens to that Samsung TV? You buy it. You go buy it. Well, what happens? So I just bought a $1,000 TV, and then my consumption went up by 1,000. I consumed that TV. You're not math majors? 100,000 minus 100,000 is 0. What if you didn't buy it? What happens then? It's an inventory. Okay? So this fact, so-called fact, that imports drive down GDP is wrong. It turns out that this is so prevalent that people believe that imports are a drag on the U.S. economy. Nothing could be farther from the truth. It's not a drag. See, it says not a drag. You're going to have copies, you're going to get these slides. There's a long article here as to explain why this is exactly the case and why many people probably, but almost everybody makes this mistake. Now I want to talk about AI. I told you I was going to jump all over the place. Machine learning and dark shipping. So Tariffs are used for certain things. For example, tariffs can be used to, correct, some balance of payments thing. George talked about that. Can raise tariff revenue. It distorts prices at what it does. We can use it to punish other countries, blah, blah, blah. Tariffs make us poorer. It makes the goods we consume more expensive, okay? Maybe it's worth it to save some jobs, maybe not. That's up to you to think about. But it makes us poorer. The other thing we can do is we can find some countries we don't like what they're doing and sanction them. We can sanction them by telling them, we're not going to buy your stuff. And we can convince other countries to do this as well. So, for example, Western authorities imposed numerous oil sanctions on Iran, Syria, Venezuela, and Russia, which means Western countries cannot be buying oil from these countries. So again, limit power, blah, blah, blah. They're getting all their money from oil, and they're using it for bad stuff. We don't like that. So dark shipping, it turns out. So every ship in the ocean has this thing called the automatic identification system. They have a little transponder that goes off every 2 seconds. Okay? We know where every ship in the world is every 2 seconds. We know where it's going, we know how fast it's going, we know how the depth of it, everything. Okay? So it turns out, once in a while, as you know electronics do, it goes off. There's no signal that comes for a while. Our friend Jesus Fernandez Villaverde, who's one of the machine learning experts in the world, he got the data. It's public data. You guys can get it too. He looked at 330 million observations. Every ship, every 2 seconds. You can do it too, if you know machine learning and have a big enough computer, et cetera, et cetera. This is what that transponder looks like. This is an example of a signal gap. It was on for a while, then it goes off, then it comes back on. Here's more what it looks like. Oh, before I get there. This is something else you see. So he can track ships. By the way, you know that ocean thing out there? There's not a lot of traffic. There's no big rocks in the middle of the road. Why would a ship have this pattern? Why would a ship be going along and all of a sudden go backwards and then go forward again? Why would a ship that's going from here to here go along for a while and then, whoops, there was a rock in the road, better move it, come back here? The other signals they get is this one. This is called AIS spoofing, which what this ship does, it keeps going around in circles and in doing weird things, and then they think, oh, the machine screwed up. This is an example. So you get 330 million observations of data, and you can forecast where these things might be going when the transponder is off. And you train this artificial intelligence system to do this. So what you see, for example, ship is going along just fine. All of a sudden, the signal goes off, and then there's a long data gap. The signal comes back on, and look at that. But the machine says, hey, you know what? There's a suspicious port nearby. And that suspicious port, what I'm going to do now is I know how fast it's going when it started. I kind of know where it is. And what I can do is I can order a satellite image of where I think that ship would be. Sure enough, look at this. This is a ship not supposed to be in Iran getting oil, and it did. Okay? Ship-to-ship transfer. An Iranian ship comes, it transfers with another ship that didn't go to Iran, for example, and you can track that one. So sure enough, you see these ships heading toward each other, and then the signal goes off. Order a satellite picture. ship-to-ship transfer. So you might think to yourself, okay, sanctions, how often does that happen? And by the way, if you think about imports of goods, that they get expensive, how often do you think illicit stuff happens? You might not think this is a big problem, and what we've done is we've really screwed these countries. 43% of all oil shipments went to sanctioned ports. 43%. It's not like 2%. Almost half went to these sanctioned ports. They'll figure out a way to get around these things, right? And by the way, what's really interesting is, so Western countries are not supposed to be buying the oil, but guess who did buy the oil? China. They didn't care about Western sanctions. So what China did was, hey, nobody else is buying your oil, so guess what? We'll buy your oil, but you know what? We want a lower price. We're not spending that price up there because you can't sell it anyway. They bargained for a lower price for oil. Well, that meant they could produce goods cheaper and ship them cheaper. But guess who benefited? We did. Because we got to buy the cheap goods that was made with the cheap oil that was from sanctioned ports. Ingenious, whoever developed this idea. We were better off because of these sanctions, even though they were supposed to be stopping people from doing that. Anyway, this is stuff you can do with machine learning now that we could not do before. We could not analyze 330 million observations at one time. So I'm not going to tell you how to do it. You can figure that out on your own. I'm just saying this is the future. This is what's going to be happening, trying to figure all this stuff out. So let me wrap up. Uncertainty seems to be the watchword. Jim was talking about that. That's why I asked that question. The Fed agrees. They're on hold for a while. They're going to see how things work out. We don't need to create our own recessions. There's enough of them out there, right? We don't need to create our own. Is a recession looming? Well, Jim talked about the Kalshi data. This comes from Jeremy Piger and Chauvet, who basically use this model to look at real-time data. And the real-time data they use is data on employment, industrial production, a bunch of real things, not the stock market, anything like that. And they put it all together and decide whether we're in a recession or not. This is as of May 1st. And what you can see is their model works well when we're in a recession. It says we're in a recession. Today, that number, it turns out, is 0.8. That's the probability the current data tells us we're in a recession today. Not in the future, but today. So the data is not telling us we're in a recession. And what I always like to leave you guys with is my optimistic view of the world. This one. It's one of the most beautiful pictures of all time. I put it in logs, just because. This is our real GDP, our real income, our purchasing power, the amount of stuff we're able to buy. What you can see here is this thing is really close to a straight line. That's why it's in logs. This growth number I showed you was about 2%, something like that. Every year, on average, we get 2% richer. And what I tell people to do is tell me what stands out here. What stands out? The Great Depression and World War II. That's what stands out. How many bad presidents have we had since World War II? How many good ones? They're little wiggles. The presidents are little wiggles. That's what they are. This is a big case we have coming forward, the tariffs. And as you can see, they've already backed down on a lot of them because you can understand what happened with the Great Depression. And as Jim mentioned, Smoot-Hawley. The beautiful thing is, if we're left alone, we're a very productive country. We've done really well over history. We're growing faster than Europe right now. And about tariffs, Right now, we're going to be drinking California wine. Thank you very much, everybody.